Um, I'd like to welcome LCNB, very interesting franchise in the Cincinnati, Dayton, Columbus, Ohio area. It's an interest to both growth and income investors. I'll turn it over to the LCNB team. Eric Meilstrup is the CEO, and you got a big group. So as you start each one doing your piece, just introduce yourselves. That would be great. So let's turn it over. Let's begin. Thank you for coming.
Well, thank you very much for the opportunity. We do appreciate it. And yes, my name is Eric Meilstrup. I'm President CEO of LCNB National Bank, and been with the bank for a little over 34 years now. And yes, as we kind of flip back and forth amongst people, we'll give name and rank as well when we do that. But to get started, we'll hop like all the way up to page 4 of the deck. And we are a bank, probably like every other bank you hear, a community bank. We are headquartered in Lebanon, Ohio, which is 30 miles north of Cincinnati, 30 miles south of Dayton, about an hour or maybe hour 10 minutes southwest of Columbus, and then within 2 hours we're from Louisville, Lexington, and Indianapolis. So we sit in a nice little spot in Southwest Ohio, and obviously have been serving Warren County now for 145 years. But we are now in 10 counties, have 30 locations. We're $1.9 billion in assets at the bank level. When you factor in mortgage servicing and our wealth area, and we are an ICS customer, we get a little over $3 billion in terms of size that way. We have been together as a management team for a long period of time, been able to see a lot of growth and seen a lot of different people who have kind of grown up within the bank, and we've been able to add talent. I will tell you from a growth standpoint, we have done 4 acquisitions since 2013, 5 if you go back to 2007. And we'll talk a little bit more about that in the second. If you flip the slide to page 5 there, kind of gives you a little bit of a picture of where we're at. Obviously, we don't have a branch location in all of those colored areas there within Ohio, but that's kind of show you where really our customer base is. We go over the borders into Kentucky and Indiana. And like every bank out there with how you can bank today, we have customers all around the country, even all around the world. But a couple of points here, down in that blue area and a little bit of the orange and yellow is where we have been for a long period of time. That 2013 acquisition we did got us into Chillicothe, which is Fayette and Ross counties, which is that yellow area there on the screen. Then we got into Preble County, which is west of Dayton, in 2014 with an acquisition. 2015, we acquired a small bank in Brookville, Ohio, which is just west of Dayton. And then our most recent acquisition was in 2018, which is in Columbus, which got us up in that green area there in terms of the central part of the state. We had a loan production office there, but had an opportunity to partner with the bank, and it kind of gave us a well-established customer base at that point in time, which we were really excited about. So really nice area. I'd say very compelling markets, like the slide indicates, a lot of growth within those areas. We touch a little bit on rural spots. We touch a little bit in the urban spots. We have a nice little mixture of different types of markets too, which has also helped us, I think, be able to attract and maintain and keep our cost of funds somewhat low over the years. So healthy markets that we're excited to be in, and a lot of opportunities still with even in those markets, as I think Brad will tell you a little bit later in terms of, especially wealth opportunities. If you go to page 6 of the deck, it talks a little bit about community. Like most bankers, I'd like to think, you want to get involved. It's part of our DNA. We have a large officer base who are very involved in a lot of different things. We not only think that's good business, we think that's very good, obviously, for the communities that we both work in and we live in. But one of the big things that I see the benefit of is how connected we are with the people that we work and live with, and the opportunities that it gives us, and the opportunities to make our places where we do live and work even that much better, but it also brings business opportunities. So very excited about the desire and the efforts that we put forth within the community. If you flip to the next slide, just, here's kind of showing a picture of kind of how we've grown over the last decade. Again, a lot of us have been here through this whole, well, everybody on this call has been here through this whole period of time. But both at the bank level and at the wealth level and with everything that we manage, we've been able to grow each and every one of those things through building branches, through acquiring branches, through acquiring institutions and partnering with them, and then just organic growth as well, looking for those opportunities. And you can see what we've done over the last 10 years. And when we say we believe we can double in size, going forward, hopefully you see a similar type chart as we go and look over the next decade or so, and using those same philosophies of both organic growth and partnering with banks and looking for opportunities within different markets. So we've been real excited to see the growth within our bank. It's served us really well, especially as we've gone through the Great Recession and even through COVID, to have our wealth area grow as well as they did. It has provided opportunities for us to be able to hold on to relationships, hold on to customers, which has been really nice. And I think it's been able to just take care of them in a holistic way and not in just one particular way. So with that, I'm going to kind of flip this over and give it to Rob, who will get you to, I think, on slide 9 and start talking a little bit more about some of the financial highlights that we have.
Thanks, Eric. And good morning, everybody. So we're just going to start off with our second quarter financial kind of highlights. We feel like we had a strong quarter. So year over year, asset growth or quarter growth was increased a little over 50 million. Obviously, our asset quality from Q2 21 to 22 was already low in 21, but went from a 0.18 to a 0.3 in non-performing assets. Pretty historical lows there, and we have a long history of outstanding asset quality. So 0.03 there, and then also our earnings per share has shot up pretty considerably, about 7.5% increase year over year from 21 to 22. So with that, we'll go ahead and slip to the next slide on page 10. Capital highlights. We've had a fairly aggressive stock repurchase program that we've put in place, and we still have a stock repurchase plan in place, and we have been buying stock back, and we will continue to do so when it makes sense and we would feel like our stock price is undervalued. But in addition to that too, is we're also continue to increase our dividend. And as the slide shows you, since 98, we've increased our dividend on a compounded annual growth rate of 3.5%. We never cut our dividend. We held it flat during the Great Recession, but since then we've continued to increase it again, like we did prior to that. And as you can see, our dividend payout ratio is in the 40 to 50% range. Go to the next slide on 11. And so we focus on some pretty key strategies to continue growth and create value with our diverse revenue stream. Continue to manage the operating expenses and just do prudent risk control and grow those relationships. And that takes us to page 12. On that, so one of the things is just having that diverse revenue stream. Our non-interest income continues to do well for us during some of these low interest rate times in the past. And so we do have a large fiduciary income book that in our wealth area, which Brad will speak to here shortly, but other items in the non-interest side as well. That takes us to 13. And with that, I'll introduce Brad Rupert, Chief Investment Officer.
Thanks, Rob. Good morning. Yeah, we do have a very diverse and nice wealth department. You can see on the slide here, we've taken a little bit of a step back in our AUM here this year with market's selling off. But overall, we've had a really good, strong trend growth for really a better part of a decade or longer. We did cross over the $1 billion mark last year, a little bit of a step back this year, but it's a diverse group with two main lines of business. We have a broker dealer that works with LPL out in our branch network that helps to serve some of those lower end clients, anywhere from 5,000 all the way up to 500,000, diverse product line. And then our trust group manages typically 500,000 and up. Average client size is closer to $1 million. Full service trust department. And we also offer financial planning. So it's a diverse group, well-credentialed group. We've got close to 30 total associates now in the wealth department. That includes 7 attorneys, 5 fully licensed brokers out in the branch network, 3 certified financial planners, and 2 CFAs. So it's a well-credentialed group that has seen a nice growth over the last decade. I'll turn that back over to Eric.
Actually, I think I'm going to do the next slide. So we're going to speak just to our acquisition strategy. So we've done 4 acquisitions since 2013. And we just like to explain our approach is we tend to be very disciplined and make sure we have the right fit from a culture standpoint. But we do have an identified strategy too of a target of up to over 70 banks that we would be interested in pursuing based on that, and would continue to pursue those opportunities as well. So we'll go to page 15 as well. Here we're kind of explaining our digital strategy. We're a little unique where IT reports up through me as a past IT administrator. This is something near and dear to my heart, but our digital transaction growth has been tremendous, even beyond COVID. It continues to grow, and as well in that we're able to gain some efficiencies, obviously in-house as well, by increasing our paperless accounts. So we continue to push those. We've refreshed our entire ATM network over the last several years, so that continues to be a strive to go forward there as well. I feel like we have top technology as our mobile and online banking as well. So, and we continue to make improvements on our business online products as well, and more to come there in the next year. On page 16, we have extremely low cost of deposits. Banks always maintain that low cost, and it seems when we have kind of economic downturn that we expand that, and historically we've been able to retain that, and we still feel like we will be able to. And we will fund growth through we have a large investment portfolio that we can use to fund our growth as loan demand increases. So cost of deposits in June we're at a 0.19 and continues to hold steady. And then Matt will take the next slide on loans. Matt's our Chief Lending Officer, and Matt, I'll let you take it away.
Good morning, everybody, and thanks for having us. We've got the customary lending services that you'd find in any community bank. The difference in us is we're heavy in CRE. About 65% of our gross loans are devoted to CRE. We have a steady growth model. The board has allowed us to pursue that steady growth model as opposed to high growth expectations. And we look for asset quality to remain steady and low. We've had great asset quality my entire career here at the bank. And as Eric or Rob, one of the two, said earlier, it's as low as I've seen it here recently. Out of that CRE portfolio, 65% of it is non-owner occupied, 35% is owner occupied. I have a constant push on the lenders to find more owner occupied. We like that. Non-performing loans, as Rob said earlier, are very low right now. If you go to the next slide, it kind of has a breakdown. I don't think that was the slide. slide 18, I think.
I'm sorry.
That's all right. Has a breakdown of what our CRE is mostly consistent of. Retail buildings, we typically shy away from big box. We concentrate on smaller retail, smaller areas that support our communities that we all live in and work in. Our office portfolio is highly concentrated in low level, and we determine low level to be less than 3 stories. I don't think we have anything at present on our books that is over 3 stories, which means we're dealing with accountants, physicians, lawyers, and typical places that people are still going to work in the office at. Mixed use can be anything from retail on the bottom to multifamily further on up. Our hotel motel portfolio is performing. We prefer to look at only good flags with operators that are well respected, and like all our deals, we look to have good liquidity on all the clients. And I don't know whether Eric or Rob has that next slide.
I think it's up. I think it's me again. So thank you, Matt. Thanks, Matt. So kind of just to finalize, I think I've said disciplined a few times already on a few other slides too, but so management's remained disciplined, and we've had strong earnings growth historically over a long period of time. So, and just, you know, we're focused on doing those things for our shareholders into the future. Net interest income continues to increase year over year. Annual net income there on the slide, you can see, continues to increase, and try to increase earnings per share going into the future there as well. And we'll just go to the next slide on page 20. And you know, our capital levels, they do support our strategic initiatives in both organic growth and through acquisitions I had mentioned before. We have significant funding sources. Our liquidity remains very strong with off balance sheet liquid cash available to us on a daily basis. And we have capacity to continue to do our share repurchases as we've proven, and continue to do so into the future. And with that, I'll turn it over to Eric for finish up.
Well, yes, to keep us going and keep us on time, I won't go over each one of these last remaining slides, but I will get a highlight on it. You know, we do have, I would consider, you know, I'm a little biased, of course, a good engaged management team. I for as excited I am as about the management team that we have here. It's a nice blend, again, of people who've been here a while and people who've come into the bank with experience. We also have what I would consider a really good level of next generation type people all behind us. And even recently have seen some really nice additions added to our staff that is, in my opinion, really been nice to be able to just have comfort that we got good, solid people around us. Our board is, which is most of the remaining parts of the slides, a very engaged group as well, a very diverse group as well. And you know, on slide 23 here, this goes back to what Rob had talked about with our dividends, as you know, just a history of continuing to raise them. Even during the Great Recession, we never lowered them. And then obviously we got kind of back on track of raising them over the last few years. And then the slides beyond here kind of highlight some of the board. You know, we've had some newer board members in the last few years. Skill sets, you know, we see it all the time, how much and how valued they are in terms of what they know and what they bring to the table. I think our relationship with them is very good. And they're just good, solid people as well. So with that, that's kind of our formal presentation of our deck there, and we'll kind of open it up to questions, and we'll let you guys take back over, and we'd be happy to respond to anything and address anything you guys want to ask.
Great, thanks so much. Really learned a lot from the presentation. I'm going to try to combine some of the questions coming in the interest of time. Generally about buybacks. There've been a couple questions. One, and you can, maybe this is a holistic question you can talk about. You had done a significant buyback earlier in the year. Someone wanted to know and get a better understanding of that transaction because it was large. It was like an 8.5% shareholder. And then in addition to that, does that preclude future buybacks? And your equity ratios and your various comprehensive income marks, how does that play into buybacks? So maybe if we could just spend a little bit of time on how you think about your buyback strategy.
Be happy to. I'll kind of take part one and then I'll flip it over to Rob to kind of finish up with it. I'll address, we had a shareholder who had been a shareholder for a while and then obviously had a significant stake and really had a desire to like to be on the board. Like any shareholder, communications, talk to the individual. And fortunately, we did at that time and still do have a very active, engaged governance committee. And we were looking and had been talking to a number of people about another board member. And this particular person was part of that process, interviewed with our governance committee and everything. We chose obviously to go a different way, chose to pick somebody that we put on our board soon thereafter or before and was very pleased with that addition in terms of what Key Lawson, who was that individual, added to our board. She added, not only diverse from a skill set standpoint and an age standpoint, but there's a lot of not only diversity reasons why, but also skill sets why that has really added to our board. But going back to that particular shareholder, once that happened, we were presented with an opportunity then to get out of that, did that in a way that ended up being very accretive to earnings per share for our shareholders. And we had a current buyback program in place before. This obviously accelerated. It was a one-time large one, and it hasn't really stopped us from doing it going forward. And I'll let Rob to speak to that here in a second. So, it was a situation where a lot of healthy discussion, just chose a way, and then we moved on from that. So all in all, I think it was very good for our shareholders, and we felt and still feel very comfortable with our decision. Rob, with that, can I turn that over to you? And you want to add anything more about just the buyback in general?
So since that time, we've authorized an additional buyback program, and we've been exercising and have been buying stock back as in our last filings. And we've probably been, I would say, maybe a little bit more disciplined. That probably means we're probably buying back at a maybe our price point is a little different, a little lower when we buy back, but it's also been lower. So we've been participating quite a bit actually because of that, just due to how the markets, all stocks have been in this space. So we continue to buy. We're buying at a slower rate, I would say. We're not buying big blocks, but small portions each day. I think a question was also asked about the negative OCI marks and our TCE ratios, that looks at our buybacks, kind of answers the same way. We are still willing to buy, certainly when we're trading at a lower rate, and that we just feel like this is too cheap for our stock, then we're buying back on those days when we're available to. And so it's not really affecting our buyback program, the large block that we did earlier. And I think and we're seeing the results in our financials. Our return on equity are up. Obviously our EPS is up quite a bit. And and it's been accretive because we've been buying below book.
Another attendee asked, you had mentioned acquisition opportunities. Are you actively looking for deals? What does your ideal partner look like? How do you look at tangible book value dilutions and tangible book tangible book value payback time in a deal?
So, Eric, I'll go ahead and answer if that's okay, but
Sure.
the answer is we're always looking, always actively looking. Now, we're not looking for aggressive takeovers or anything like that, but, true partnerships with other community bankers that we meet with on a regular basis. And that's how we get to know, bankers and other banks to see if they would be a good partner for us. There's the culture of the people, but there's also a credit culture that's important to us. And we're not in the business of maybe buying a troubled bank as much as a bank that's got a credit culture similar to ours. And so those are important things. Metrics, we look for, a payback period, certainly under 4 or less, but we really like to get closer to 3, obviously, or 3 or less. We have a policy in place that has some metrics involved that sometimes we kind of have to compromise on one to get another to get a deal done. And so no 2 deals are the same. A lot of it depends on the market. The last deal we did in Columbus was a highly desirable market. We feel like it, we already had an LPO office there. We were looking to possibly put a branch in, and we feel like that acquisition advanced our efforts in that market by 10 years. And so it made sense to pay, and the price for that market was more expensive. So that was a little uncharacteristic for us, to be quite honest. We would look to typically be more disciplined in our amount that we would pay and not overpay for a deal.
Mm-hmm. So here's a question happening the other way that, given your solid performance, given your attractive market, are you receiving presentations or investment bankers chasing you to sell your franchise to somebody? Which I know you have a limited way to answer that, but in the same opportunity, do you have in the same vein, do you have a process in place should you receive some interest?
Well, I'll answer that one. I mean, if you do a good job, I'm sure there's a lot of people who wouldn't mind wanting to partner with you, right? And I think with our results over the many years and consistent results, yes, you have to have a process, of course. But I think what's important here is, we have a desire to be independent. We have a desire to want to keep, pushing our brand and our franchise in a similar way than we have in the past. So that is where we tend to focus most of our time on.
Okay, we've a little bit of time left. There's a hand raised. Let's see if we can unmute. Okay, I think we're on. Ted, you there?
Yes. Firstly, I want to say you asked most of my question with regard to the Super 70 possibilities. And I'm wondering about size of companies ranging from the low end to the high end, and whether you would be interested in somewhat expanding your footprint.
I'll start, Rob. I'll let you add. So expanding our footprint, yes, we'd love to expand our footprint. I think we have opportunities to expand. I think we also have opportunities even within our footprint. But I think the most important thing has got to be the right deal for the right reason, with the right culture and the right fit and everything. In terms of size, of course, we'd like for it to be a little bit, you do a lot of work, spend a lot of time. So, on the smaller end, you'd like for it to be, let me just throw out $100 million or so. But, I think we would look at something even less than that if it was the right thing to do. I think, and Rob, forgive me, we have bought institutions that were about a quarter to maybe a third of our size before. And, that's not something we would shy away from. But again, we'd go a little below, a little above that too, if it made the right, if it was the right move for us and everything. I think what's important in all this too, that gets factored in is not just, building the brand, but in especially today's world, people become a big part of this as well, the acquisition of talent. So that plays a role in a little bit of this too, that could make you want to go up or lower. So Rob, with that, other than saying, we'd go north, we'd go south, we'd go east, we'd go west. I mean, I don't think I don't think we're pretty particular about which way, as long as it was the right move. But Rob, anything to add?
I think on the size question, I think that 250 to 500 would be kind of like the sweet spot, but those aren't hard limits. I think, if one came in at 600 million, that looked like a great opportunity at a good price, then we would certainly jump at that chance. And the same thing on the lower end. If there was, something sub 250 or 200, I think we would certainly give it the right due and due diligence and examine that closely to see if it made a lot of strategic sense for us. And but when you get smaller, there's definitely economies of size there that you got to look at, can I get the cost saves on the acquisition cost of it to get it to have it make sense. So that usually means you're paying a lower price for it. So that usually helps it for sure. So you get the value out of it there, but it's just, can you get the price low enough? And the trick is getting their expectations for the target bank to understand that as well. And sometimes they're realistic and sometimes they're not.
Great. Well, we really appreciate you making your presentation, everyone. Very dynamic story. Very happy to have you. Also want to thank Rob and your new board member. They had spent some nice time with us,
Sure.
a generous amount of time. So Julianne and I could understand your bank and understand what's happening there. So
Certainly.
I do appreciate your time. So thank you.
Absolutely. Thank you for the
your time.
opportunity.
Appreciate it.
Mhm.